So one of the issues we're tracking for you today on the program, of course, is the story that broke yesterday, Nigeria's inflation figures released by the National Bureau of Statistics. We saw headline inflation galloping 0.83% to 18.3%, with food index at 17.1, and that was up about 0.47%, and urban as well as rural indices were up 0.81 and 0.84% respectively to 15.3 and 13.3%. But how is all of this affecting the market? Is it really shaping any of the decisions taken by the market operators and investors as well? I'm being joined on the program by the Chief Executive Officer of Cowrie Assets Management, Mr. Johnson Chukwu. It's great to have you join me on the program this morning.
Good morning, Harriet.
Now, it wasn't a surprise that Nigeria's headline inflation actually accelerated for the month of October. But what do you make of this latest data?
Well, it was expected, like you rightly pointed out. But the key challenge is how do we moderate, what do we need to do to moderate the inflation rate? And it looks like the measures so far taken have not been able to rein on inflation, because the measures we've taken, we are not actually addressing the core reasons why inflation has been in an uptick.
But then also taking a look at this, what do you think should be done now, especially as the markets seem to have priced this in already? Do you think that they'll be reacting negatively? And what do you think for those who are saddled with the responsibility of monitoring these numbers? What should be the next step?
I think that's the key thing, because next week we'll be having the MPC meeting. And how do they respond to it? I've always pointed out that the inflation we are seeing in Nigeria is cost push and not necessarily demand pull, and therefore not driven by liquidity overhang. But we unfortunately will be fighting inflation as if it was driven by liquidity overhang, and therefore we'll not be able to achieve results. We have structural challenges in the economy. We have the issue of FX, whose pass-through effect, I mean, the continued devaluation of Naira has impacted on the price levels. And what we need to do is how do we address that, and not necessarily how do we suck up liquidity in the system and therefore create higher interest rates. And I think we are fighting inflation using the wrong tools, because the inflation was not driven by demand and rather it is driven by a cost push.
So for you, what would be the right tools?
Well, the first thing we need to do is inflation today is largely FX driven. So how do we improve the supply of FX? What we've been doing so far is to fight FX challenges, the exchange rate challenges, by fighting FX as if it is cost push. And for me, if you look at the FX issues, there's little the government can do to moderate demand, because we've done everything to manage demand and that has not worked. We have banned 41 items from assessing FX, any of the windows of FX. It has not brought down the demand for FX. As the size of the economy, with a 94 trillion GDP, there is a minimum demand we have to live with. Even if we're able to change the consumption pattern of Nigerians, and we need to generate enough FX to meet that. So in the short term, I would say the shortest route to moderating the inflation rate is improving FX supply, and that will come most likely from government borrowing. And I'm not subscribing to the 29.9 billion, but I'm saying the government must borrow. Egypt just got approval of 12 billion from IMF. We must determine what amount of forex we should borrow. Then we also must determine what other methods we need to attract long-term forex inflated economy.
But then you know that the federal government, although right now they're looking for book runners for the 1 billion euro bond that they're proposing to issue by the end of the year, do you think this will give some sort of bounce to the market? What do you think investors are thinking about the economy right now in light of all of these issues that you've raised?
Okay, in the first place, the $1 billion will be too little to have an impact. I was thinking that. You see, what is missing, which is what your next question is, what do I think investors are expecting? What is missing, investors are looking for clarity. They are looking for a clear economic path that the government wants to follow. And then that path will have strategies and tactics. It will show milestones of what we want to achieve. If, for instance, the government said the $1 billion we are trying to borrow from the euro bond market is a segment of the borrowing plan of the government. And the borrowing plan of the government is that we're going to borrow 10 billion. But beyond the aspect of borrowing, the government also earmarks certain assets for concessioning to the private sector. The big thing economists, investors are looking for, would they need to see the government economic direction? Is the government going to drive a command and control economy? Are we going to focus on, are we going to create a market-driven economy? And are we going to open up several sectors of the economy for private sector capital to come in? It is private sector capital will help us stabilize the exchange rate and rein in on inflation.
But you see, most people will argue with you, particularly from the government side, that they have indeed gone ahead to create an enabling environment to make it more market-driven. So are you saying that this is not enough, or that's not the signal that the market is getting?
Well, if you talk to private sector investors, which I am one of them, I can tell you that clearly we are at best confused on the economic policy direction of the government. And it's even worse when you deal with foreign direct investors. Most of them are sitting on the fence, watching to see if they can get better clarity. And in a lot of instances, foreign investors do not sit and wait idly for a country to open up its economy. There are several things we need to look at. I have mentioned the issue of, if you take, for instance, the local investors, we have an interest rate regime that makes it impossible for local investors to go into this sector unless they're getting subsidized funding from the government, like some of these development finance initiatives. You cannot borrow from a bank, any bank at 22%. In fact, today the banks are not even lending. Most of the banks have been risking their balance sheets. So you realize that for private sector operators, accessing capital for economic activity is almost very difficult to achieve. For foreign direct investors, they are looking at stability in the FX market. They're looking at the windows of opportunities, the sectors where the government has opened up and created an enabling environment for them to invest in. And those things are not very clear. You can't say today, we have talked about infrastructure. What are the legal framework? What are the frameworks for concession of critical infrastructure? Which of the infrastructure have been earmarked for concessioning? What are the timelines? You need to define all these things and then advertise them and ask for bidders. We've not seen that. If you look at, for instance, the power sector privatization, it went through a process that included advertising for bidders, accepting bids, setting the criteria for bids, appointing advisors, and before those who were selected. We need to do something on key infrastructure, the road networks, some of the critical truck A roads that the government does not have capacity to fund. We need to open them up for private sector investment. We need to define the legal framework. We need to define the commercial framework for those private sector capital to come into those areas. And we've not done that. So what we are saying today is at best at the level of sentiment. We want our people to be able to invest, but you must create the incentives. They must see the opportunities before they put in their money. And they must be able to dimension the risk.
So do you think that aside from probably the government engaging with the private sector, it should also at this time engage more with the state governments?
Well, the state government is part of the overall governmental structure. I want to believe that to a large extent the engagement with the state government has been quite intense. I mean, recently we saw a municipal publication that the government wants to release about 760 billion to the state government as arrears of whatever they called it. I think they said it has to do with adjustment of over deduction or thereabout. Government has granted forbearance to state governments. Government has even given them handouts. So for me, what we need is macroeconomic framework that will guide anybody who wants to invest in this country, who wants to do business in this country, be they local investors or foreign investors. We must not ignore the local investors because they are very critical to the economy. In as much as we create the environment for the foreign investors, we must at the same time create opportunity for the local investors. Local investors are not investing today because they can't access funding. Foreign investors are not investing because they are not clear your economic direction. They are not clear which sectors have been opened up. The oil and gas sector, we've been talking the petroleum industry bill for God knows how long. That has not come into pass. Today, we are talking of concessioning of railways. We need to see the legal and commercial framework. We should be talking of concession of some of the highways. And I've always said this, the government revenue in Nigeria today will never be enough to build all the critical infrastructure we need to catalyze economic development to the point that Nigeria will be a cost-effective producer of goods and services for world export unless we build this infrastructure, and the government cannot have the money to build infrastructure. So we need to open up the economy for private sector investment. That is what we are looking for. They are waiting for government to give direction to that.
So, looking at government to give direction, some are saying that the government should get innovative and not borrow. But you feel that, well, the government should go ahead and borrow. And even though it does that, it should still give the private sector enough room to come in and do business.
Well, yes. What I think is that what we need to have is a holistic funding plan. That holistic funding plan will include some element of borrowing. It will include some elements of capital that will come in from private sector to go into critical infrastructure development. It may even include sale of some idle or less productive assets and converting the income from that, the revenue from that, into some other beneficial economic assets.
But then, Johnson, people don't want to hear. People don't really want to hear that the government should any advice whatsoever that the government should maybe look at selling any of its assets, whether they're idle or not. The assets that they've sold before now, you talked about the Power Holding Company of Nigeria. They feel that that wasn't properly handled, and so any attempt right now to advise that maybe the government should sell any of those assets might not be greeted with positive reactions.
Okay, let's take a classical example. You know, there's a company called NAFCON that used to be called NAFCON. You know of it?
Yes.
National Fertilizer Company of Nigeria, you know, NER. That company is now called Notori. That company was dead, almost buried, eventually sold by government, and it is now functioning. You are aware that NITEL is functioning again as NTEL. That NITEL that was run by government, almost shut down, has been sold to the private sector. It could have been sold much earlier. And if it was sold much earlier, probably get more value from it, and they would have created a lot of economic benefit from it, creation of employment, revenue, taxes, and the other rest. But let's look at the one that the government is still holding on to. The refineries. They were sold in 2006. The sale was revoked in 2007 by the then Yar'Adua's government. The refineries have not worked. The government, I understand the average production of the refineries productivity of the refineries is about 20%. The government is thinking of putting about under $1 something billion for another turnaround on those refineries. We may never get the money back. If it had been sold to the private sector, had remained in the hand of the private sector, probably the refineries would have been working. And today, maybe would have been a net exporter of petroleum products, refined petroleum products, instead of being a net importer. There are several assets of the government hold that are redundant today, that are moribund, that if they sell to a better manager of those assets, a more professional manager of those assets, then the government we can extract value as a country. The issue of the sale of the power plants, there may have been some mistakes along the way, which should have, as a country, we should learn from and then correct them. There are certain things that should have been done on the part of the government. The issue of gas supply, the gas supply is still out of government, the transmission grid is still out of government, that needs to be improved upon to make it, to be able to attain the objective that we have set out in the privatization of the power sector.
All right,
we need to look at
Johnson
what
Chukwu
has gone wrong, and then we correct them.
Thank you so much for your perspectives this morning on the program. Johnson Chukwu is the Chief Executive Officer, Carry Assets Management Limited.